Something unusual just happened at the heart of the global financial system, and most people completely missed how serious it actually is. The Federal Reserve cut interest rates by 0.25%, a move that on the surface looks routine, almost boring, something markets have seen many times before. But this time, the reaction from the White House was immediate, aggressive, and unusually public. Reports suggest the president made it clear that this cut was nowhere near enough, openly pushing for a double cut of 0.5%. And that is where this story stops being about interest rates and starts becoming something much bigger. This is not a technical disagreement over decimal points. This is a power struggle over who truly controls the cost of money in the United States. At stake is the line that separates monetary policy from politics, a line that has been carefully protected for decades because once it breaks, it is almost impossible to rebuild. The key issue here is not whether lower rates help the economy in the short term. Almost everyone agrees they do. The real issue is what happens when markets begin to believe that central bank decisions are no longer driven by data, but by political pressure. Once that belief takes hold, confidence becomes fragile, expectations shift, and the system starts to behave differently. Investors no longer listen only to economic signals. They start watching speeches, elections, and headlines. That changes everything. This single 0.25% cut has exposed a deeper fault line that has been quietly widening for years. On one side is the Federal Reserve, designed to think in multi-year cycles, inflation expectations, and long-term stability. On the other side is the political system, which is naturally focused on growth now, markets now, and results that can be felt before the next election. When those two logics collide in public, the consequences ripple far beyond Washington. That is why this moment matters. Not because rates moved slightly lower, but because the argument over how much they should move has become a public political battle. And once interest rates turn into a political weapon, the global financial system enters much more dangerous territory. To understand why the White House reacted so strongly, you have to step inside the logic of political economics rather than central banking theory. From a political perspective, interest rates are not abstract tools. They are levers that directly affect growth, jobs, markets, and voter sentiment. Lower rates mean cheaper borrowing. Cheaper borrowing means businesses invest more aggressively, consumers spend more freely, asset prices rise, and optimism spreads. In that framework, a 0.25% cut looks timid, almost symbolic. Reports suggest the administration views the economy as capable of running hotter without immediate danger, especially when unemployment remains low and financial markets are still absorbing capital at a rapid pace. From this viewpoint, failing to cut more aggressively is seen as leaving growth on the table. There is also a global dimension to this pressure. The United States does not operate in isolation. Other major economies have relied on low interest rates and accommodative monetary policy for years. That has kept their currencies relatively weaker, supporting exports and competitiveness. When U.S. rates remain comparatively higher, the dollar strengthens. A stronger dollar makes American exports more expensive and reduces the competitiveness of U.S. manufacturers abroad. For policymakers focused on trade balances and industrial revival, this is a real constraint. A deeper rate cut is seen as a way to relieve that pressure by softening the dollar and leveling the playing field. Politics adds another layer. Strong economic performance is one of the most powerful narratives any administration can run on. Rising markets and easy credit create a sense of momentum, even if underlying risks are building quietly in the background. From this angle, the Federal Reserve's caution is not seen as prudence, but as resistance. That is why the call for a 0.5% cut is not just about stimulus. It is a signal that monetary policy should align more closely with growth priorities and competitive strategy. The problem is that this logic, while politically coherent, directly conflicts with the principles that keep monetary systems stable over time. And that conflict is exactly where the tension now sits. From the Federal Reserve's perspective, the situation looks very different. The central bank is not tasked with maximizing growth at any cost. Its mandate is narrower, but far more demanding. It must support maximum employment while maintaining price stability, and it must do so based on data rather than political urgency. When the Fed chose to cut rates by 0.25%, it was making a calculated move designed to provide insurance against external risks without unleashing forces it might later struggle to control. Economic indicators did not signal a recession. Growth remained positive, labor markets were tight, and asset prices were already elevated. In that environment, a larger cut risked overstimulating an economy that was not actually weak. Inside the Federal Open Market Committee, this tension was evident. The decision was not unanimous, reflecting deep concern about moving too aggressively. Some members worried that even a modest cut could fuel excess risk-taking. A double cut would have amplified those fears. Another critical factor is credibility. The Fed's power does not come from force, it comes from trust. Markets believe the Fed will act decisively against inflation when necessary, even if that action is unpopular. If the Fed appears to bend under political pressure, That belief weakens. Inflation expectations can rise before inflation itself does, making it much harder to manage later. The Fed also signaled restraint through its communication. By avoiding language that promised ongoing accommodation, it made clear that policy would remain data-dependent. This was not indecision. It was a deliberate attempt to preserve flexibility and independence. From the Fed's standpoint, cutting 0.25% was the maximum move that could be justified without compromising its long-term role. Anything more would have risked sending a message that political demands now shape monetary policy. In a system built on expectations, that message would have been far more dangerous than any short-term slowdown in growth. If the Federal Reserve were to fully give in to political pressure and deliver a larger cut, the most immediate damage would not show up in growth numbers or employment reports, it would show up in credibility. Central banking works because markets believe that policy decisions are insulated from electoral cycles. The moment investors suspect that interest rates are being set to satisfy political demands, expectations begin to shift. Inflation expectations in particular are extremely sensitive to perceived independence. Once households and businesses start believing that future inflation will be tolerated for the sake of growth, behavior changes in advance. Workers push for higher wages, companies raise prices earlier and more aggressively, investors demand higher long-term yields to compensate for uncertainty. None of this requires inflation to actually rise first. It is driven by belief. That is what makes it so dangerous. A larger rate cut under pressure would also set a precedent. Political actors would learn that public criticism works. Future policy debates would become louder and more confrontational. Markets would no longer focus solely on economic data. They would track political calendars, speeches, and opinion polls. Volatility would rise because uncertainty would no longer be confined to economic cycles. It would expand into the political arena. The Fed would then face a paradox. To restore credibility, it might eventually need to tighten policy more aggressively later, even at the cost of a sharper slowdown. That delayed correction would likely be more painful than cautious restraint today. In this sense, giving in once increases the probability of harsher outcomes later. The irony is that the short-term boost, promised by deeper cuts, could be offset by higher risk premiums across the system. Borrowing costs at the long end of the curve could rise rather than fall. Financial conditions could tighten even as policy rates drop. This is why independence is not a theoretical concept. It is a functional requirement. Without it, monetary policy loses its anchor, and once that anchor drifts, the system becomes far harder to control. Lower interest rates do not flow evenly through the economy. They concentrate first in asset markets. If rates were cut more aggressively, the immediate beneficiaries would be borrowers with access to capital rather than wage earners. Real estate would feel the impact almost instantly. Cheaper mortgages increase purchasing power but not supply. When demand rises faster than new housing can be built, prices climb. This disconnect pushes home values further away from household incomes, making affordability worse even as credit appears easier. Investors sensing momentum accelerate the move. Leverage increases, speculation replaces necessity, the same dynamic plays out in equity markets. Lower rates justify higher valuations by reducing discount rates. Growth stocks in particular benefit as future earnings are valued more aggressively. But when valuations rise faster than underlying cash flows, risk accumulates quietly. Investors become less sensitive to fundamentals and more dependent on liquidity. Margin use expands because borrowing costs are low. This creates fragility. Any shift in expectations can trigger forced selling amplified by leverage. Asset inflation also widens inequality. Those who already own assets see their wealth grow. Those who rely on wages face rising living costs without equivalent income gains. This social effect feeds back into politics, creating more pressure for continued accommodation. A loop forms where asset-driven growth demands ever lower rates to sustain itself. Breaking that loop becomes increasingly painful. When policy eventually tightens, the adjustment is sharper. Prices correct faster than incomes can adjust. What initially looked like support turns into instability. This is why central banks fear overstimulating asset markets more than missing marginal growth. Bubbles do not announce themselves clearly. They build through optimism, cheap credit, and complacency. A deeper cut at the wrong moment would not just raise prices, it would raise the stakes of the eventual correction. Interest rate decisions in the United States do not stop at its borders. The dollar sits at the center of the global financial system. A more aggressive rate cut would almost certainly weaken the dollar, at least initially. From a domestic political perspective, that might seem beneficial. A softer currency helps exports and eases trade pressures, but globally, the effects are far more complex. Capital flows respond quickly to changes in U.S. rates. Lower yields push investors toward higher risk markets in search of return. Emerging economies may see sudden inflows of capital. Asset prices rise, credit expands, but these flows are often unstable. They reverse just as quickly when conditions change. This volatility creates financial stress rather than sustainable development. Other major economies would also be forced to react. A weaker dollar could push the euro or yen higher, undermining export competitiveness in Europe and Japan. Their central banks might respond with their own easing measures. The result is not coordination, but competition. Currency markets become more volatile. Global trade becomes less predictable. The role of the dollar as a stable reserve currency relies heavily on confidence in U.S. policy discipline. If that confidence erodes even slightly, diversification accelerates. Central banks and sovereign funds begin exploring alternatives not because the dollar collapses, but because uncertainty increases. Over time, this raises borrowing costs for the United States itself. The privilege of issuing the world's reserve currency depends on restraint as much as power. In this sense, aggressive cuts driven by domestic politics risk exporting instability abroad and importing higher costs later. Monetary policy that ignores its global footprint ultimately weakens the very position it seeks to protect. Looking ahead, the situation now breaks into three realistic paths, and none of them are comfortable. The first path is the one the Federal Reserve is clearly trying to preserve. In this scenario, the Fed maintains its independence, keeps decisions tightly anchored to data, and accepts slower, more controlled growth as the price of stability. Rates may move gradually, but only in response to clear economic deterioration rather than political pressure. The immediate result is frustration from politicians and parts of the market, but the longer-term effect is predictability. Inflation expectations remain contained, capital markets price risk more accurately, and volatility stays manageable. Growth continues, but without excess. The second path is more subtle and therefore more dangerous. In this version, the Fed does not openly surrender, but begins to lean incrementally toward political preferences. Communication softens, future guidance becomes more accommodative, and cuts arrive sooner than data alone would justify. Markets interpret this as a signal, even if it is never stated explicitly. Risk-taking increases, asset prices climb, and short-term growth looks strong. But beneath the surface, leverage builds and policy space shrinks. The Fed still claims independence, but credibility erodes slowly rather than suddenly. The third path is the most counterintuitive. Aggressive easing fails to deliver the growth it promises. Structural constraints such as demographics, productivity, limits, and supply-side frictions prevent the economy from accelerating meaningfully. Inflation pressures rise without corresponding output gains. Real incomes stagnate. The central bank is then forced into a difficult reversal tightening policy more aggressively later to regain control. This scenario produces sharper downturns and greater political backlash than restraint would have caused in the first place. What makes this moment critical is that markets are already positioning around these possibilities. Expectations are forming now, not later. Every signal, every statement, every decision nudges probabilities in one direction or another. The path chosen will shape not just interest rates, but the credibility of monetary policy for years to come. When monetary policy becomes a public political battleground, the damage goes beyond any single rate decision. The deeper issue is precedent. Central banks rely on a shared belief that certain decisions are protected from short-term political incentives. Once that belief weakens, it is extremely difficult to restore. Politicization does not need to be formal to be effective. It only needs to be perceived. If markets begin to assume that future policy will tilt toward electoral needs rather than macroeconomic balance, uncertainty becomes permanent. Policy signals lose clarity. Long-term planning becomes harder. Investors demand higher compensation for risk, not because fundamentals deteriorate, but because governance does. This affects government borrowing, corporate investment, and household confidence simultaneously. Over time, the cost of capital rises, even if policy rates fall. The paradox is that attempts to engineer faster growth through pressure end up slowing the system structurally. The Federal Reserve occupies a unique role globally because of the dollar. Confidence in its discipline supports not just U.S. markets, but global liquidity. If that discipline is questioned, other central banks adapt defensively. Reserves diversify gradually. Financial architecture fragments. None of this happens overnight. It unfolds quietly through risk management decisions rather than dramatic announcements. The long-term consequence is a world with less coordination, more volatility, and higher baseline risk. The Fed's cautious stance, therefore, is not resistance for its own sake. It is an effort to preserve an institutional boundary that underpins stability. Once monetary policy is openly politicized, every future decision is interpreted through a political lens. Even correct actions lose effectiveness because trust has been diluted. This is the hidden cost of pressure. It does not just change outcomes. It changes how outcomes are perceived, and perception in finance often matters more than reality. At its core, this entire debate is not really about 0.25% or 0.5%. It is about what kind of economic system the United States wants to operate in. One where short-term growth is maximized whenever possible, or one where stability is protected even when patience is required. The Federal Reserve's restrained move signals a belief that credibility is a form of capital just as real as money itself. Spend it too freely, and it disappears. The political push for deeper cuts reflects understandable pressure to deliver visible results quickly, but visibility is not the same as durability. History shows that economies rarely collapse because policymakers move too slowly. They collapse because discipline erodes quietly until shocks become unmanageable. By holding the line, the Fed is not blocking growth, it is buying time and preserving optionality. That choice may be unpopular, but it is strategically rational. The real risk lies in crossing the boundary where monetary policy becomes a tool of political contest rather than a stabilizing force. Once crossed, returning is difficult. Markets remember. Trust once lost is expensive to rebuild. The question now is not whether rates will move again. They almost certainly will. The question is who ultimately sets the logic behind those moves, data or pressure, stability or speed. These choices shape the future long after headlines fade. And they matter not just for the United States, but for a system that still depends heavily on its financial leadership. So here is the real question for you. Should a central bank ever sacrifice long-term credibility for short-term momentum? And if political pressure continues to rise, how long can institutional independence realistically hold? Let me know what you think in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.